So we have a webinar every Tuesday at 4:30 p.m. Called the Options Tribe. And we bring options experts from all over the world, actually, to the webinar every week to explain option strategies and different aspects of options trading theory. And last night we had a very interesting guest, a guy named Bubba Horwitz, who was a market maker for many years and has his own options education business. And Bubba talked about a very interesting strategy that is applicable to people who trade options, particularly options going into earnings or some other event where a gap is expected. And so what Bubba explained is that a lot of traders get into a trap where they have gotten a correct call on a stock. They buy a call option on that stock. The stock rallies as expected, but it rallies in the aftermarket, and the trader can't close his trade even though he'd like to lock in his gains and close the trade. So what is he to do? And Bubba has a unique approach to this that I'd like to share with you. So let's take a stock which reported earnings yesterday, TTWO, and towards the end of the day was trading around 105. And so if you went into the market to buy a call option at that 105 strike, you would have to pay about $4.35. Of course, everything's multiplied by 100 in options, so you'd have to pay $435 plus your commissions. You'd only do that if you thought there was a good chance that TTWO was going to rise more than the cost of the call option, after earnings. That would be a logical thing to do if for some reason you felt that that was likely. Now, let's take a look at a profit graph of this transaction. As you can see, the worst it gets for the trader is $435, and theoretically, infinity is the best it gets for the trader because there's no top on stock. So if the stock goes to $1 million, you'd make an awful lot of money. So the long call is a strategy that many intraday traders use if they're feel very strongly about the direction one way or another of a stock. Now, after the market closed, TTWO reported, and the market loved this report, and the stock very rapidly in the after hours ran up to 118. So a trader who owned that 105 call that he paid $4.35 for, let's do the math on that. And let's forget about the fact that the option still has some time value in it. Let's just talk about the intrinsic value of the option. If it's up at 118 and you own the 105 call, the value of that options contract that you own is $1,300 because the stock's up 13 points from the strike price and you multiply it by 100. So ignoring the extrinsic value, the option would be worth at least $1,300, and therefore you would have made at least $870 or so on the option. However, you haven't made anything on it because you still own it. And if you want to close your position, you got a problem because you have to wait till the next morning when the options market opens up again, at which point the stock could have been traded down back to 105, could have been traded below 105. You don't know what could have happened. If you felt like your target had been hit and you wanted to close out of the position, you're basically stuck until the next morning, unless you implement this idea that Bubba presented to us last night on the Options Tribe. And that is, if your broker allows you to trade after hours, sell short 100 shares of TTWO at 118. Now that sounds counterintuitive, doesn't it? Why would you sell short a stock that you are trying to lock in, sell short the stock when you're in a long position? And the answer is that's a way that you can synthetically close your long call. So let's take a look at what this looks like on a risk graph now, or a profit graph. Now you're up your 870 bucks and you've effectively closed the position so that no matter what happens to the stock, you will still make roughly your $870. Why? Because if the shares sell off from 118 and the call starts to deteriorate, your short position starts to appreciate. So while your call is depreciating, you're almost dollar for dollar, very close to dollar for dollar. Your short position is appreciating, and therefore you have basically negated the effect of the stock selling off from 118. So you've more or less synthetically closed your call. However, you've done something more, which is very interesting, and that is you're now short that stock. So if the stock somehow retraces, and it doesn't happen that often, but if the stock somehow retraces and ends up selling off heavily, you would do well to hold on to those shares and possibly make a big profit on the way down. Now, at that point, the call might be worthless, but your short position is so valuable that you'll be able to kind of get a lottery ticket for free for the downside on the trade. But in any event, you've locked in the gain of the upside of the trade. So if the stock rallies further, well, you're not going to be able to take advantage of that rally. You've closed your benefit from the upside because you're now short from 118. So if the stock goes to, say, 120, your short position will lose $200 from the 118 level, but your call will appreciate approximately 200, and therefore that will happen all the way, up and down. So therefore, you've locked your gain in. But if that was your target, you would have exited the call at the target if the market was open anyway. So the conclusion is selling shares, in a long call position effectively closes the trade, but allows you and puts you into a position of closing the trade if the market is closed for those options. You don't have to sit there and worry and watch your position deteriorate conceivably in a retracement and not be able to do anything about it until the next morning. You can take matters into your own hands and actually close the position. So those of you who are intraday options traders, think about how you might apply this. It's got to be in a situation where you're holding the option overnight and a big gap is expected. That's where this comes into play, and this might solve a problem that's faced your trading in the past, and hopefully it can be helpful. So thanks very much, and we'll see you next week.